Good morning, everyone. This is your market update for Wednesday, September 24th. So, starting from the US dollar index, the index slipped to around 97.2 on Tuesday, extending losses from the previous day as traders reassessed the Fed interest rate outlook. Last week, the dollar rallied on a strong US economic data and higher treasury yields. But momentum has faded as expectations for the Fed policy have become more uncertain. And St. Louis Fed President Alberto Mussolini also noted that there is limited room for additional rate cuts without pushing policy into overly accommodative territory. And the US Treasury yields held steady overnight, while the Deutsche Bank suggested that the upcoming PCE inflation may come in weaker than feared, easing immediate pressure on the Fed. And markets are still pricing in two more rate cuts this year. But the direction will depend heavily on Friday's PCE release and Fed Chair Jerome Powell's comments. And in a speech overnight, Powell highlighted that the economy has shown resilience despite the major shocks in recent years, but acknowledged that the risks have shifted. The growth has slowed and unemployment has edged up, and downward side risk to jobs has risen. And at the same time, the inflation has picked up recently, driven mainly by the higher tariffs, with total PCE now running at 2.7%. And Powell emphasized that the near-term risks to inflation are tilted to the upside, while the risks to employment are on the downside, creating a difficult balance for the policymakers. And at last week's meeting, the Fed lowered rates by 25 basis points to 4.25%, moving the policy closer to neutral. Powell described policy as still modestly restrictive, leaving flexibility to respond as data evolve. He reiterated the Fed's commitment to maximum employment and bringing inflation back to 2%, stressing that the policy is not on a preset course. So technically, the dollar index remained fragile. RSI has fallen to about 43, and if prices fail to hold 97, a drop towards 96.81 and 96.22 could follow. And resistance sits near 97.64 and the psychological 98 level. And moving to WTI crude oil. In the energy markets, the oil rebounded strongly, climbing more than 2% to close at $63.6 a barrel, snapping a 4-day losing streak. The move was fueled by geopolitical tensions, including NATO's pledge of a robust response to Russian airspace violations and Ukrainian drone attacks on Russian refineries. Kurdish exports from Iraq also remain stalled, keeping around 230,000 barrels per day offline. Despite this rebound, the medium-term outlook is still pressured by rising global supply, a weaker demand growth, and the structural shift towards electric vehicles. And on the charts, crude bounced before testing the 61.4 channel floor, showing resilience. And stronger downside levels remain at 60.78 and a key at $60 level. And the upside resistance is seen at 64, and then the 100-day moving average at 64.4 with scope towards 65.6 if the momentum builds. So, turning to spot gold, the gold prices surged to a new all-time high of $37.91 per ounce on Tuesday, extending Monday's nearly 2% rally. The market is being driven by expectations of further Fed easing and safe haven flows amid the global uncertainty. And geopolitical tensions continue to provide support from the Russia-Ukraine conflict to instability in the Middle East. And technically, Bollinger Bands are widening, confirming heightened volatility. Gold is consolidating above the 36.98 5-day average, with the 3700 psychological level now acting as support. And resistance lies around 3800, and a sustained break could open the way to 3850. Support levels are at 3750 and then 3698, with the 14-day average at 3654 as a deeper defensive line. So that's all for today's morning review. With Powell's comments, upcoming PCE data, and ongoing geopolitical developments, the markets will remain sensitive to shifting signals. Thank you for watching.